One thing I love doing here on the channel is every once in a while making a video about different buyer's remorse stories as they come out, because I feel like it's a very important thing to cover, because basically these stories are designed to scare you, because if it doesn't and you don't pay attention and basically learn from other people's mistakes, then you can easily fall victim of the same mistakes yourself. So really, these buyer's remorse stories are more of a cautionary tale on things to avoid, rather than, oh my God, you should never buy a house. It's definitely not that. It's how can you buy a house smart and not make these same mistakes. So let's take a look at some of the most recent buyer's remorse stories. And I want to thank one of my subscribers, Carl, for sending this article to me. So first, let's go over some figures. Ever since the housing market peaked back in May or June 2022, only from then until September, the housing market as a whole lost about 8% of its total value / equity. And what that means for anybody new or you don't understand what equity is, it just means how much your home is worth minus what you owe on it. It just means that home values have gone down 8% from June till September. And to put into perspective just how much money 8% is when we're talking these crazy home values that we have today, that means people have lost a collective $1.5 trillion in equity in just a few months, guys. That is huge. Now let's take a look at buyer number one. This is a couple from Canoga Park in California, which is pretty much a suburb of LA. It's north of Hollywood. Basically, this couple decided to take a chance, and what they did is they recently bought a condo in Canoga Park, but they pretty much had to stretch their budget to the absolute limit to buy this place, okay? And they went into this thinking, we'll stretch now to get into the property, and then in a year from now, hopefully rates will be lower than they are now, and we'll just refinance. That was their plan, okay? They submitted a lowball offer, and they did okay in the sense that they got 7% off the home's asking price. And I wish the article would give the details on the purchase price as well as the home buyer's down payment. Unfortunately, they don't. But if we just go by averages, or the median down payment that a home buyer will put down on a property throughout the entire country is 13%. So I would say we could just round that down to 10% for most buyers. That's usually how much most people I've seen will put down, especially when they're buying a house. Although when you buy a condo, a lot of times you have to put a higher down payment, but it didn't say. Now, this couple had made a lot of sacrifices in order to buy this property. They stopped taking vacations, they stopped eating out. They basically cut back on all the fun stuff from their budget to make this purchase. Now, because California is seeing some of the sharpest drops in home equity first, more than a lot of other places right now, this couple is at the highest risk of continuing to lose value or home equity in their newly purchased condo. And the thing that they're worried about is not actually being able to refinance when the time comes, because they thought maybe in a year from now they would be able to refinance. But here's the kicker, guys, and here is something that we have been talking about over and over again on the channel. When that year passes, they've owned the place for a year, and the housing market continues to go down, because you can pretty much guarantee at this point home values are going to continue to drop well into a year from now. So their home that they purchased is going to now be worth less than what they initially paid for it. And even if interest rates are lower by then, which is probably a very low probability, and if they are lower, it's not going to be by much, they're not going to be able to refinance. So their concern is now they're going to be stuck with this payment that they were not planning on being stuck with. You know, essentially that's their problem right now. So their plan of jumping in and refinance later is most likely going to backfire, especially if they're like the average home buyer and only put 10% down, because once their property drops 10% of value, guys, they have lost all of the equity in their home and are now in a negative equity situation where their home is now worth less than what they paid for it. So This is a huge mistake that a lot of first-time home buyers typically make, and it can be easily avoided. And how do you avoid this? There's a couple ways to avoid it. First of all, you can put a higher down payment. That's the first thing you can really do. But the other thing that you can do is to make sure 100%, since a lot of people actually can't put a higher down payment, they just don't have the money, is to be 100% certain that the money that you're paying for your property monthly is very comfortable for your monthly budget, not stretching to the max like these people, because now they could find themselves in the situation where one little hiccup can ruin their life and they'll lose their condo. So that's the last place you want to be in as a home buyer. And I see people that are smart all the time in the comment sections of my videos saying, that's why, I bought a home that was, $100,000 less than what I was approved for, to make sure it fits comfortably into my budget. Those are the type of things you need to be doing if you're going to buy right now. It needs to fit very comfortably into your budget if you're going to be out there in the market. Or the other thing you can do is just wait it out. You can do whatever you want. I'm just saying that waiting right now is not such a bad idea, especially since home values are likely going to be lower in a year from now. So then you'll have better opportunities than you'll have today. But these type of things can just be easily avoided by making sure the home payment fits nice and comfortably into your monthly budget. You put a high down payment, 20% or more, and the purchase price is of value, okay? If you're getting a deal that you feel is worth it in today's market. So basically, if the property doesn't check all three of those boxes, I personally wouldn't be buying it right now. And here's something before I move on to the buyer number 2 story that a lot of home buyers don't understand. Like real estate investors, they complain about real estate investors all the time, buying up all the inventory. But even small mom and pop investors like me, and when I buy an investment property, guys, you have to put 20% down minimum. Sometimes more depending on the property. If it's multifamily, you usually have to put 25 or 30% down. Same thing if it's a condo. So investors always have to put a large down payment, whereas regular home buyers can get away with these smaller down payments, but it puts them in bigger trouble, essentially. Now the next one is from a couple out of Boyle Heights, California, and I'm not sure where that is. I didn't look on the map before, but they bought a home last year and are hearing the sounds of gunshots on the regular. So now they're afraid of taking their kids to the playground in their local neighborhood because they hear gunshots nearby. And now they're wondering if they made the wrong choice and really didn't research the neighborhood well enough before making this purchase. And I would say this is arguably just as bad as the previous scenario, because people like this just did not do their homework on the area, and you're stuck with this house, guys. Even if this person can turn around and sell it and not even lose any money, which would be a miracle essentially, because think about it, even if they can turn around and sell it, they're going to be paying realtor fees, closing costs, taxes, costs to move, etc. There's a high chance, especially if they're another ones that put 10% down, that they're going to lose if they decide to sell right now to get out of this area, okay? And even if they do go through all of that, imagine the amount of effort and work and the stress that it puts on their family to pick up and move just a year later after they moved into this house because they didn't research the neighborhood well enough. I mean, talk about learning a lesson the hard way. That is just terrible, guys. And it's another one that can just be easily avoided. You can walk through the neighborhoods like I'm doing right now and really scope things out. You can do it at different times of day too. You can walk during the day. You can walk at night. You can walk on the weekends when a lot more people are home. See who's there. Figure out the situation. And the other thing that I notice is a lot of people are actually too lazy to get out of the car and walk the neighborhood like I'm doing here. Instead, they'll just drive the neighborhood and they don't spend a lot of time there, But I can tell you firsthand from doing all these walks that you definitely see and experience a lot more walking through an area than you're ever going to taking a drive. So I think it's worth the effort when you're spending all this money on a potential property to just take that hour and, do the walk, guys. Figure it out before making the purchase, because it's a huge purchase. You have a lot to lose, like these people. Now, buyer number 3, these people are basically gamblers, and you'll find out why in just a second. So this one is another couple, and the husband used to work for Coca-Cola, and it was time for him to retire from Coca-Cola, and he had the option to take his pension in one lump sum. So he was able to actually get his pension in one lump sum instead of the usual monthly payment that most people will get. And so what they did is they used most of the money from that pension lump sum to put a down payment on a new construction home in Riverside County. And this guy actually decided to get another job at a bakery, and their plan was in 3 to 5 years to retire and sell this house for a profit and then move to a cheaper area of either the state or the country. So what's wrong with this plan, guys? Well, there's two big ones, two big red flags I want to point out here. First of all, they decided to put the down payment on this property last year when the market was still soaring and booming. Everything was going up. No one thought it could ever end, okay? That's the first mistake they made, following this market trend, thinking that it was going to last forever. And then the second mistake is taking, what's equivalent to this person's life savings, instead their lifetime pension fund, and putting it into this property. And their only strategy here was hoping that the house is going to go up in value and they're going to sell it at a higher price later on. If you guys have been watching my channel for more than a minute, you've probably heard me say a couple of times, this is a terrible idea. Terrible, terrible, terrible. You never ever want to buy a property for an investment with the sole plan being, well, I'm going to sell it at a profit in 3 to 5 years, and that's how I'm going to make my money off of it. No, guys, you never want to do that. If you're going to make investments in real estate, sure, you want to come out ahead and sell the property for more than you paid for it down the road. But in the meantime, that property needs to be rented and it needs to be cash flowing. And that is not the case for this person. So they made a huge mistake with that. They basically made a very foolish choice by trying to buy this property and hope to sell it later for a profit. But that strategy usually doesn't work when the market is heading in a downward direction, because there's a high probability in 3 to 5 years from now that property will be worth less, or if they're lucky, the same as what they paid for it. And their retirement plan is going to be completely botched. And the fact that they just, put everything into this and made it their sole retirement plan to, basically flip this house down the road and make a bunch of money was a big mistake, guys. And I'm surprised anyone would be willing to do this, because there is just so much at risk. And if you want to have a shot at retiring and this doesn't work out, I mean, to me, that's equivalent to just walking into the casino and putting, this money on the roulette table and putting it all on red. That's what they're doing. And you need to see how that analogy works. They're just gambling, hoping that it's all going to work out, when in fact, it's not working out at all for them. Because newsflash, buy, hope, and pray is not a real estate investment strategy. And you would think people in their 60s like this would already know that, being through several real estate booms and busts throughout their lifetime, but apparently they didn't know that. And one thing to realize is not only can all these things be avoided with a little extra due diligence like we've been talking about here, but you have to understand that as more and more people start losing equity in their homes, this is going to also have a side effect of slowing down the economy overall, because a surprising number of people use their home equity to boost their life in the form of paying off debts, using home equity lines of credit to do remodels, or they refinance the house and do cash out refinances and take the money out every few years. People do all sorts of things with their homes that they probably shouldn't do, these basic financial shenanigans, if you will. And what happens when all this home equity starts to dry up and people don't have access to this anymore? This will slow down the economy overall, because it's such a big part of how people spend money. You talk about all these people you see that look like they're rich all the time, and you feel like you're the only one who's broke. Well, this is why, guys, because there's people out there spending money that they don't have. Their house has the money. There was a basically a funny phenomenon happening during the pandemic where people were saying, oh, my house is earning more than I am now, which was true for a lot of people. And that's how people get in trouble, because they're using their home as like another income to live off of and pay their bills and do all these things that they shouldn't be doing. And when that stops, when the musical chairs stop and everyone's looking for a seat, that's when you're going to see a lot of people get in trouble with this. In fact, they have an example in this article from cancer patients. There was a study done saying that a surprising number of people, that when they get diagnosed with cancer, people who have home equity versus the ones who don't are usually the ones who end up deciding to pay for the treatments, and the other ones that don't have home equity, they usually just choose to die instead, because they don't have the home equity to draw on in order to save their own lives. Just how crazy that situation is right there should show you just how reliant and dependent people have become on their home equity as another source of revenue. And there was some interesting data attached to all of this as well, because according to Black Knight, in 2011, it was estimated about 30% of mortgaged homes, or about 16 million properties, were underwater, meaning that they owed more on the property than it was worth in 2011. And right now, as of today, only about 8% of properties are underwater. The funny thing about this is that Black Knight is saying, oh, more people will continue to fall underwater, but it's not going to be nearly as bad as the last housing crash, because we have higher lending standards this time, as well as the fact that this crash isn't going to be as bad as the last one. Well, here's the funny thing about Black Knight and what they said. They're pulling data from 2011 saying that 30% of mortgaged properties were underwater, okay? But the housing crash really started in 2007 to 2008. So we're talking, over 3 years later after the crash began, that's when there was 30% of homes underwater. Now let's do a little math. What year is it? Oh yeah, it's 2022, it's almost 2023, but we can pretty much say that the housing crash began this year, because since June, we have seen an 8% drop in home prices nationwide, okay? So June 2022 marks the start of this housing crash, and if it follows the same pattern as last time, we have to go 3 years into the future, so we're talking June 2025 when we might see 30% of homes underwater. So come back to me in June 2025 and let's revisit how many homes are underwater then. That's the thing that gets me upset when I read these articles, and I try to warn you guys of how this might end up, because real estate is a very slow falling knife. Because you always see all these people that say, oh yeah, it's definitely not going to be as bad as last time, everything's going to recover, by this time next year, and it's all going to be good. Well, that's not how the housing crashes work out, guys. And all we have to do is look back to the last one to see that. And Black Knight's own data saying that 2011 was when they saw 30% of mortgage homes underwater. So it's reasonable to say that in 3 years from now is when we might be seeing the most amount of homes underwater. And that's when I keep pounding that this is just getting started. It really is. We're going to have a lot to talk about over the next few years with this housing crash. And as it all develops, I'll of course keep you guys updated on all the details, like I have been. But not everyone is worried about this, and not everyone should be, because there was one other guy, an example from this story that I want to mention, because this guy bought a house for $777,000. I don't know why they only told the price for this guy, but they didn't share any of the sold prices on the other properties. I wish they did. But anyhow, this guy said he bought this property and he doesn't care that he overpaid for it, so he's basically admitting he paid more than what the house was worth when he bought it, because he plans on staying in the home for at least 10 years. And this is what I always tell you guys on the channel too. So honestly, somebody like this maybe doesn't need to be that worried about it, but they still put themselves in a vulnerable position from the point of view that they overpaid for the property. So they will be in a negative equity situation over the next couple of years, which is a guarantee they will be. But the question is, will they be able to keep their income, and will they be able to keep making their mortgage payments so they don't end up losing the property? So kind of like the other people that took the huge gamble and put the entire pension fund on red on the roulette table, this guy is basically doing the same thing, and his bet is that I'm going to be able to keep making the mortgage payment. And I don't know what his mortgage payment is. I don't know what his income is. Maybe he will be able to. I hope he does. You know, nobody wants to see people get thrown out of their homes, but when people are taking risks like this, that's what happens. And that's why we need to pay attention to this stuff to make sure that you don't make the same mistakes. So after hearing all these scenarios and people's different buyer's remorse stories, I think it's very easy to avoid all of these problems, guys. You pretty much just need to have a small checklist of criteria for your property to determine whether or not you should buy. And that should serve you well in the coming years. If you are already feeling like you can't afford the payment when you first get into the property, definitely don't buy it. And the number one reason is, even forgetting about negative equity and all of this, the number one reason not to buy a property like that is because expenses go up, okay? People say, oh, that's the best thing about buying a property is, you know, I know what my expenses are going to be for the next 30 years. Well, no, you don't, guys. You know what your mortgage payment's going to be, but that's where it ends. Because guess what? Property taxes over the years go up. Home insurance goes up. I shared with you guys in a video a couple months ago, my expenses on my place are going to go up 60% next year. 60% in 1 year. Now, that's going to be an anomaly year, and I don't expect to see increases like that again for a very long time. But if my wife and I could not afford that, we would be done. Okay, we would be another one of these victims and another one of these people I'd be talking about here in the videos. It'd be my own story. But we can afford it, and we factored those things in when we bought this property. Okay, a real big one is, besides the monthly payment being comfortable, is your down payment. If you can only afford a 5 or 10% down payment on the property in times like this right now, when the market is heading down, that's a recipe for disaster for you. And it's probably a sign that you shouldn't be buying right now, because technically you can't really afford it. You can't afford to lose the amount of equity that you stand to lose in the coming years if that's all you have for a down payment. So really low down payment buyers right now need to take extreme caution, and just keep in mind, if you do decide to buy, you're buying at your own risk. Think about the lifeguard sign where you see swim at your own risk. That's exactly what you're doing with this. And the final thing is, if you're going to be buying an investment property, the cash flow and the numbers need to make sense from day one when you purchase the property, and not be just buying completely off of speculation, and your only plan is that the property value is going to be higher in a few years from now, because there's a high likelihood that it won't be because of the situation that's happening. So if you follow these 3 simple rules, you're going to come out ahead of this thing. And it's not that hard to do. The hard thing is fighting the impulse and fighting the FOMO to not fall into these traps. If you guys enjoyed this video, make sure you hit the bell notification down below. YouTube will alert you every time I put out a new video. And if you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.